I got this question the other day, and it was about how to become basically the best investor. And in this video, I'm going to give you the best way to become a world-class investor or trader. Because when it comes to investing or trading, most people simply can't outperform the market over a long period of time. They might have a few big wins or some lucky streaks, but over time, they end up giving all their money back. And those who have mastered one essential component of investing win, and that is risk management. So I know that sounds boring, but hold up. When a rookie investor thinks of risk, they usually just think about money only. But there's actually 14 types of risk that will all contribute heavily towards the success or failure of a profitable investor or trader. Professional investors, whether that's investing in business or stocks or trading or whatever, making money is a byproduct of managing risk well. And the more you can be aware of these risks, the more money you can make. So my goal for this video is to educate you on these hidden risk factors that most people aren't aware of, so that you can focus on not losing money and making more. Because accumulating remarkable returns is inevitable when you stop losing money unnecessarily. So let's get to work. All right, so as I said, a bulletproof risk management regime is absolutely paramount to any successful trading or investing strategy. Even the best trading strategy in the world can eventually blow up your account if it's not integrated with strict money management principles. I've known a number of investors or traders who are brilliant at technical analysis, but they still lose money due to their lack of risk management. And when a rookie enters a trade or invests their money, their first thought is often, how much money can I make from this? But the first question a professional asks is always, how much money can I afford to lose on this trade? Protecting your capital must be your first priority, which is why I say making money is a byproduct of mastering risk. Now, there's 4 big risks that most people are kind of aware of, right? And I want to run through those with you real quick. So the first is company risk. When you invest your money into one company, you're effectively putting all your eggs in one basket. And then if that company goes bust, so does your money. So then there's sector risk, because you think, okay, to overcome that, I might invest into Apple and Sony and Microsoft and Nvidia and AMD. And by doing so, you've exposed yourself to the tech sector risk, which means if that sector goes down, so does your money. And then there's time risk, which is a big one. Time risk is where you repeatedly try to get in at the right time. You try timing the market to buy the bottom and sell the top, and that is a common mistake. Time in the market is more important than timing the market. More on that in a bit. And then there's asset risk. So even the top 500 companies listed on the top stock exchanges don't collectively go up every year. So to smooth the equity curve and reduce any volatility further, you can consider adding a balance of differing assets such as commodities and bonds to your portfolio to smooth out that equity curve. So those are the 4 big risks that a lot of people know about, and I'm going to talk to you about how you can overcome these risks in a moment, but I want to talk about some of the other risks that people get caught out with. The first one is trade risk. Trade risk is the amount of capital at risk. Position sizing, or trade sizing, is a fancy way of saying how much money do I put on this trade. Then you have drawdown risk, and although account drawdown is normal, it's a normal occurrence once in a while, all measures should be taken to keep it as small as possible. And the best way to do this is by keeping the risk per trade or investment to a predetermined amount of your total liquidity. Then we have correlation risk. Even if you might be only risking 1% per trade, traders who speculate on multiple markets, they have to factor in another dimension of risk management, and it's called currency correlation risk. When 2 or more markets are frequently moving in similar ways, you can come unstuck. Also, think about stocks. Imagine you pick 10 stocks and you over diversify. One of those stocks can do really, really well. It might 10x. But you don't appreciate that 10x because you're diluted across too many. So you need to get that sweet spot right there. The next one is capitalization risk. Okay, and capitalization is the term used in reference to the amount of money you fund your trading or investing account with. Although it might seem safer to trade with small amounts of money, and for the most part it is, undercapitalization can actually present its own risks in itself. Then we have gambling risk. Okay? It is possible to use your broker as an online casino. Many reckless punters approach the markets hoping to get rich quick. And the ability to trade huge amounts of leverage grants traders the intoxicating power to potentially make a lot of money in a very short period of time. That's dangerous. Then we have volatility risk. If you treat your trading or investing account like a submarine with 100 equal-sized partitions, then building cash buffers is like having multiple submarines. So you have to build cash buffers, and I'll talk about that in a moment. Then we have news risk. So keeping an eye on news announcements, that's an important risk measure that traders and investors have to monitor, but don't confuse this with watching the news, which is generally a collection of high-impact journalism designed to boost ratings. There are certain news events you need to pay attention to, and some you just don't. And then we have margin call risk. Your broker will rarely let your account drop below zero. So if a trade moves against you, or moves against you far enough, they'll even take the liberty of automatically closing the trade for you. Now, most brokers alert you before your account reaches $0, and that's called a margin call. Then we have execution risk. So execution error is any human error made on any trading or investing platform. An execution error is especially common during the learning stage. So there's certain risk management procedures that should be taken if you identify a mistake early on in your trading or investing career. And then finally, we have technology risk. And these are risks that can only be introduced through technology, such as a computer or a laptop or trading software, or a slow or unreliable computer or broadband. That will cost you time and potentially profits. So a powerful computer is highly recommended in any form of trading particularly. So now we've covered off all of the risks, I want to talk about the remedies. So how do we manage company risk? Well, don't invest in companies without understanding the financials for a start, and qualitative and quantitative analysis. Only invest in companies that you know, like, and trust, and then consider investing in more than one for less volatility. Which brings us to sector risk. How do you deal with that? You invest into diverse sectors which reduce the volatility and allow your return on investment to grow in all market conditions. This is where things like a diversified index fund is amazing. Then we have time risk. So buy the market regularly like you buy your groceries. It's not a good idea to buy your stocks like perfume, as Benjamin Graham said, who was Warren Buffett's mentor. Dollar cost average, which I've done tons of videos on. You can go and watch this one after this, and I highly recommend you do. Then we have asset risk. The way you get around that is you consider an all-weather portfolio, which optimizes growth, low fluctuations, and sustainability. You want to check out all-weather portfolios mentioned in Money Master the Game by Tony Robbins, which was by Ray Dalio, for instance. Or in my book, Always Free. Passive investments, stocks, trading, and higher speculation when managed correctly can provide the best possible returns. Alright, then we have trade risk. Some ways to combat trade risk is to limit each and every trade or investment to a percentage of your total liquidity. And this can be dynamic depending on the level of speculation. For example, large cap stock index funds, you might have 80% of your investment liquidity. Then you might have a large cap stock individual company with 10% of your investment liquidity. And then you might have a small cap stock, one stock, with 3% of your investment liquidity, and then you might allocate 1% of your investment liquidity to forex trading, and then 0.5% of your investment liquidity to crypto, etc. Then you have drawdown risk, which is where you want to know your total expected drawdown across your entire portfolio at all times. Drawdown amount versus profit needed to recover, or break even. So if you look at this table here, 1% drawdown requires 1.01% profit to recover. 5% drawdown requires 5.26% profit to recover. A 10% drawdown requires 11.11% profit to recover. 15% drawdown requires 17.64%. 25% drawdown requires 33% to recover. 50% drawdown requires 100% profit to recover. Means you have to double your account even though you only lost half. 75% requires 300% profit to recover, and a 90% drawdown requires 900% profit to recover. Now, I want to mention my Wealth Atlas tool here, which is going to be the best way that you could possibly organize all of this stuff and diversify your portfolio to suit you and your volatility comfort zone. If you want to see me do a demonstration on my Wealth Atlas tool, let me know in the comments. Then we have correlation risk. Never expose your capital to too many similar markets or companies. In a currency pair in trading, since the increased potential rewards are offset by the increased potential risks, trading multiple correlated pairs at the same time does not increase your mathematical edge. Rather, it merely magnifies your effective leverage. That is a double-edged sword. Then we have capitalization risk. So at first, traders and investors can be tempted to jeopardize their entire risk management strategy due to being undercapitalized. They increase leverage, they increase position sizing, and they end up blowing their accounts faster than anything. Let me know if you've done that. Focus on returns in percent. The skill to generate 20% on a $1,000 account is virtually the same as generating a return of 20% on a $1 million account. So focus on consistent ROI in percent and hide your P&L for now. Then we have gambling risk. So all of the following actions are regarded as gambling in the market, so don't do any of these. Taking a trade that looks good but is not a strict entry signal. Not moving your stop loss as close as your strategy states, so price has more room to move. Risking more than your strategy permits. Risking less than your strategy permits. Trading at times that your strategy prohibits. And anything else that isn't published and documented in a printed copy of your trading strategy. And if you want a template trade plan, you can get one in the description. Then we have volatility risk. How do we overcome that? Well, most people can handle winning trades and winning streaks just fine, but losing streaks are not so easy to stomach. So by ensuring that your net liquidity doesn't fluctuate by more than 10%, you eliminate most of the sting or the pain from frustrating losing streaks. I've done this many times. Stability in the mind brings about stability in your trading account. And that concept applies in trading and in investing. Perhaps you're investing in an all or nothing startup, right? And if the investment goes well, the reward is uncapped. But if it goes badly, you could lose the entirety of your deposit. So in this case, wise money management is keeping the total deposit under 10% of your liquid assets. Then we have news risk. Now there's many great resources that you can get access to, like Forex Factory Calendar if you're a trader, or TradingView have one now, a calendar. There's some great resources on x.com, but major news releases you just want to be aware of so that you're not trading off of them, but you're avoiding trades when they're going on. Things like NFP, non-farm payroll, or FOMC or ECB press conferences, and big interest rate decisions in the Asia session and things like that really volatile. They really move the market, which you just want to avoid. Elections. You don't want to be trading or investing around elections. It's just guesswork. Okay, then we have margin call risk. How do you overcome that? Well, the simple action here is to understand position sizing, lot size, price per point, price in pips. These are all terms that you need to be ultra familiar with so you can never put yourself in a position that triggers a margin call. You should never, ever receive a margin call. If you do, you're risking far too much. Then there's execution risk, and I talk about pilot consistency. When you get on a plane, there's like a 50, 60-year-old pilot in there going through a checklist. Even though he's flown thousands of these planes, he goes for a checklist to maintain consistency, to remove human error. And that's what you need to do with your trade plan, which you can get a template of in the description. But here are some methods for reducing the probability of execution error. 1, have a trading checklist to tick off with a pen and paper. Have your strategy printed out with you when you're trading or investing. Write down your figures before typing them into your order form. Perform your calculations slowly and double check that they measure up. If a trade size seems too big, it probably is. So double check it. Always double check the order form before clicking OK. And then we have technology risk. So here's some tips to avoid technology risk. Always have a fast, powerful and up-to-date computer when you're trading, and ensure that you have the latest version of your charting software and brokerage platform, and make sure you test all aspects of your laptop's functionality if you're using a laptop before leaving your house. If you're trading remotely, make sure you back up any key security files on a memory stick, and always have a copy of your brokerage login and password. Always have your broker's phone number, put it on speed dial, have an alternative internet connection, use your 4G, use a remote hotspot, make sure you've got all that access to that before. And then ensure that you can still trade if you lose power or access investments, right? If you're in a bad area. If you're day trading, you need to make sure that you have a fully charged laptop, or always have spare batteries at hand. If you're using a wireless keyboard or mouse, make sure it's charged up. And definitely avoid trading off of your phone unless it's an emergency situation. I highly recommend you don't trade off of your phone. Market conditions are not always optimal for your chosen trading and investing strategies. And if you don't have a strategy, you have no hope other than luck. There's times when choppy markets can result in a series of losses. And if your priority is to protect the money in your account during choppy market conditions, you will remain afloat to rebound from the losses and make new highs once the market condition reverts. Become dedicated to highlighting the risks that you're likely to face as a trader and investor. And by implementing the risk management principles that I've covered in this video, you will significantly increase the probability of protecting your capital and therefore becoming a very successful trader or investor. So if you want me to dive deeper into one or more of these risk factors, type which ones into the comments. And if you want to learn more about this stuff, I highly recommend grabbing a copy of my book. It's called Always Free, and definitely check out the resources. I'll put all the links in the description. Make the most of them, and I'll see you in the next one.